Owning a home in America isn't easy anymore.
But freedom is still possible with the right playbook.
From house hacking to co-buying to knowing when renting is actually smarter.
We'll uncover the keys that can protect your wallet and your future.
Hit that subscribe, bell it up, and ride the full wave with me.
Welcome back to the Deep Dive. Today, we're going to tackle something huge. The American dream of homeownership. Or maybe the American nightmare for a lot of folks right now.
Yeah, that's putting it mildly for many, especially if you're trying to buy your first place. It feels kind of impossible, doesn't it?
Totally. Like this fortress you can't get into, guarded by crazy interest rates and just, well, astronomical prices.
And that feeling, it's completely backed by the numbers. I mean, look at the typical median home price in the U.S. right now. We're talking around
Pause, hit sub, bell on, like it, share it, then game on.
$410,800.
Wow. $410,800.
Yeah. And here's the kicker. To actually afford that comfortably with today's mortgage rates, our analysis shows you probably need a household income somewhere around $126,700 a year.
$126,700. That figure is just, it's staggering. Because in so many places, that's like double the median income for one person.
Exactly. It really throws into sharp relief this huge economic shift that's happened just in the past few years. It wasn't always like this.
No kidding.
And people know it's kind of broken, right? Our sources, they show something like 70% of Americans think now is a really bad time to buy a home. 70%.
That high. Wow. So there's this climate of, I guess, fear and just frustration.
Definitely.
Okay, so our mission today is really clear. We need to look past that fear, find the strategies that are working. We're going to dig into the creative stuff, the hacks that younger generations, Gen Z, millennials, are using to get around this affordability wall.
Right. But just as important, maybe even more so, we got to expose those hidden traps, the financial sinkholes that lead to that awful buyer's remorse so many people feel later.
We want to give you the keys, basically, but also the checklist to make sure the whole thing doesn't fall apart 6 months after you move in.
Exactly. Keep the door on its hinges.
Okay, let's start with the market
Don't forget to subscribe, tap that bell, and let's chat below.
itself. Why is it still so tough? I mean, prices maybe aren't skyrocketing like they were, but supply is still super low. Prices are sticky. It feels like a perfect storm.
It really is. And it's mainly driven by, well, two big things. Those persistently high mortgage rates and something called the lock-in effect.
Okay.
So the rates first, we're seeing forecasts keeping those 30-year fixed rates pretty stubbornly high, probably in the 6.3% to maybe 6.7% range for a while. And that just means higher monthly payments, period.
So explain that lock-in effect a bit more. We know inventory is low, but why aren't people with houses selling, even with these high prices they could get?
Okay, imagine you bought or refinanced back in, say, 2020 or 2021. You probably snagged a mortgage rate around maybe 3%, 3.5%.
Yeah, lucky ducks.
Right. So your monthly payment feels pretty manageable. Now, if you sell that house today, sure, you make a profit. Great. But then what? You got to buy something else.
At today's 6.5% or whatever rate.
Exactly. Your monthly payment could literally double, even for a similar house. So why would you move? The rational answer for most is you wouldn't. You're effectively locked in by that amazing low rate you already have.
Oh, okay. So that collective reluctance keeps houses off the market.
Precisely. It keeps inventory tight and stops the supply side from, correcting itself naturally.
And this just slams first-time buyers who are often already dealing with student loans or other debts. The gap between wages and home prices is just brutal.
Oh, it's stark. Look at 2023. Average home prices jumped, 17.5%?
Yeah.
But median wages only went up about 4.5%.
Oof.
Yeah. That massive gap means saving for a down payment feels like you're constantly chasing a target that's sprinting away from you.
And speaking of down payments, that big chunk, 5% to 20%, what are the other big upfront costs that people tend to forget or maybe underestimate?
Everyone focuses on the down payment, yeah. But the real surprise, the one that often shocks people, closing costs.
Right. Those sneaky fees.
Totally sneaky. You got to budget an extra 2% to 5% of the entire purchase price just for things like title insurance, appraisal fees, loan origination fees, transfer taxes. all that bureaucratic stuff.
So on a, say, $300,000 house, that could be another, what, 6 grand, 15 grand?
Easily. Another 6.
Subscribe now, tap the bell, and drop your thoughts in the comments.
$6,000 to $15,000 you need right before you get the keys. And if you're, a younger buyer, maybe juggling student debt and already stressed about the high rates, that extra hit, it forces you to get creative.
Which brings us perfectly to the new playbook.
Yeah.
People aren't just sitting around waiting for the market to fix itself or for some, magic solution.
Yeah.
They're innovating, finding hacks to get around the wall without needing, like, a massive inheritance.
Exactly.
So let's talk about the biggest one right now, house hacking. What is that exactly?
House hacking, it's actually a beautifully simple concept at its core. You buy a property that can generate rental income right away, and you use that income to offset your own mortgage payment.
Okay.
So often this means buying a multi-unit place like a duplex or a triplex. You live in one unit, rent out the others. Or it could be finding a single-family home that has a rentable space like a basement apartment or maybe a converted garage, something called an ADU.
An ADU, that's an accessory dwelling unit, right?
Yeah.
Like a little separate apartment on the property.
Exactly. Separate entrance, its own little kitchen maybe, bathroom. And this isn't some niche thing anymore.
Yeah, I bet not.
No, the data really shows it's becoming a mainstream strategy, almost a survival tactic. Over half, 55% of millennials, 51% of Gen Z, they say, having potential rental income is very important when they're looking for a home.
Wow, over half.
Yeah. They're looking at the house not just as a place to live, but as a potential income stream from day one, like a tool.
And you found a great case study using an FHA loan that really shows how powerful this can be, right?
Yeah, it's a perfect illustration. So imagine a buyer uses an FHA loan that's government-backed, only needs 3.5% down typically.
Okay, low down payment.
Right. So they buy, say, $160,000 duplex. That's only about $5,000, maybe $5,600 out of pocket for the down payment. Much more doable.
Definitely.
Okay, so their total monthly payment, mortgage, insurance, taxes, the whole PITI might be around $1,300, but they rent out the other unit for, let's say, $900 a month.
Okay.
So you do the math. They're effectively living in their own place, building equity, for just $400 a month out of pocket. $1,300 minus $900?
Wow.
Yeah.
That's huge. $400 a month instead of $1,300?
It's a total game changer for cash flow, especially early on.
Okay, that's house hacking. Now, another strategy that seems to be getting really popular, maybe out of necessity too, is co-buying. Buying with people you're not married to.
Yes, absolutely. We're seeing a big rise in people buying with siblings or close friends, even non-romantic partners.
And why is that taking off?
Well, it's a direct attack on that huge down payment hurdle, mostly. Our data shows co-buying like this made up, 21% of transactions in 2023? That's significant.
Yeah, 1 in 5.
Right, because if you can split that initial 5% or 10% down payment 2 ways or even 3 ways, suddenly the cash you need up front becomes way more manageable. It just opens the door.
Okay, but let's be honest here. Buying a house with your buddy, that sounds like, I don't know, relying on a friendship for a 30-year mortgage commitment. That feels risky emotionally.
It absolutely can be, yeah.
But what's the big financial mistake people make? Like trying to save money on the setup.
That's exactly it. The biggest mistake is relying on trust and just a handshake agreement because you're friends. While co-buying slashes the down payment, it absolutely requires detailed legal paperwork before you buy.
Okay, like what kind of paperwork?
You need a really clear operating agreement. Often, the best way is to form an LLC, a limited liability company, to actually own the property, or at least have a very thorough co-ownership contract drawn up by lawyers.
Why is that LLC or contract so crucial? What does it do?
It spells everything out in black and white. Who's responsible for what percentage of the mortgage, the taxes, the insurance, how are repair costs split, and crucially, what's the exit strategy?
The exit strategy. Yeah.
Super important. What happens if one person loses their job, or gets married and wants out, or just decides they want to sell in 5 years and the other doesn't? You need a pre-agreed mechanism for a buyout or forcing a sale fairly.
Without destroying the friendship or someone's finances?
Exactly. Trying to save a few $1,000s on legal fees up front by skipping this step, that can turn your clever financial solution into an absolute financial and personal disaster down the road. Penny wise, pound foolish.
Good advice. Okay, so beyond these hacks, what about more traditional, concrete loan programs people should look into right now?
Always start by investigating government-backed loan options. We already mentioned FHA loans, great for lower down payments at 3.5%.
Right.
Also, definitely look into VA loans if you're a veteran or active military. Those can often be 0% down payment. Huge benefit.
0 down, wow.
Yeah. And USDA loans, those are for eligible rural and sometimes suburban areas, also can offer 0 down options. Plus, check out local and state down payment assistance programs. They vary a lot, but they exist to help bridge that gap.
So these programs are specifically designed to lower that barrier to entry.
That's their whole purpose.
And for anyone buying in this high-rate world we're in, there's this phrase that keeps popping up, marry the house, date the rate. What's the thinking there?
That's the core philosophy right now, and it makes a lot of sense. The idea is you find the house you love, the location you want, the asset you want to own long-term. You commit to the house, you marry it.
Okay.
But the interest rate, that 6.5% or whatever it is today, you just date that rate. You accept it for now, knowing it's temporary.
And you could refinance later.
Exactly. The expectation is that rates will eventually come down, maybe in a few years. When they do, you refinance your mortgage to get that lower rate.
So why not just wait for rates to drop before buying?
Because while you're waiting, what's likely happening to the price of that house you aren't?
It's probably going up.
Right. If you wait 2, 3, 5 years for rates to drop, the house price itself might climb so much that it's even less affordable than it is today, even with a lower rate. The potential gain in the home's value often outweighs the temporary pain of paying a higher interest rate for a couple of years.
Okay, that makes sense. Buy the asset now, fix the financing cost later.
That's the strategy.
All right. We've covered some really creative ways into the dream, but now we got to talk about the darker side, the hidden costs, the regrets, that buyer's remorse. Our sources said, 45% of homeowners regret something? That's nearly half.
Yeah, it's a huge number, and it often comes down to unexpected costs and overlooked details.
So what's trap number 1? The biggest one.
It sounds basic, but it's just fundamentally misunderstanding the total cost. Trap 1 is the true, ongoing, relentless cost of maintenance and just owning the thing. People fixate on the mortgage payment.
TI principal, interest, taxes, insurance.
Right. They budget for PITI, but they forget everything else. Taxes and insurance can go up, sure, but the real killer is maintenance and utility.
Okay, how bad can it be? Give us a number.
Well, for a typical single-family home, you could easily be looking at $11,500 or more per year just for maintenance, repairs, and utilities beyond the basic mortgage.
11 grand annually.
Yeah. A common rule of thumb advisors use is to budget 1% to 4% of your home's value every single year just for upkeep. Think about that. On a $400,000 house, that's $4,000 to $16,000 a year you need set aside.
Wow. So that leaky faucet, the furnace acting up, the roof needing work eventually. Yeah. That's all on you.
All on you. And we've all heard the stories, right? You suddenly realize, oh crap, I don't just own the house, I own the ancient plumbing system, the HVAC unit that sounds like a dying walrus, and, every squirrel trying to nest in the attic.
And this trap must be especially dangerous for younger buyers or anyone who really stretched their budget just to get the mortgage approved.
Precisely. If you scrape together every last penny for the down payment and those closing costs we talked about, you likely have 0 buffer, 0 emergency fund for the house itself.
So when the water heater inevitably breaks,
the only option is putting it on a high-interest credit card, digging the hole deeper. You hear it all the time on homeowner forums. Something broke, where does the money come from? Especially with high student debt, high rates already squeezing them, they just can't build that repair fund fast enough. It's a brutal cycle.
Okay, so underestimate maintenance costs, big trap. What's trap number 2? You mentioned desperation earlier.
Yes. Usually happens in those hot competitive markets with bidding wars. Trap 2 is skipping the home inspection.
Ooh, yeah. To save a few $100 or make your offer look cleaner.
Exactly. It feels like a way to win, but it's probably one of the costliest gambles you can possibly make in real estate. That inspection, it's not a nuisance. It's like essential insurance.
Why is it so critical?
Because a good inspector is trained to find the major potential problems you probably won't see. We're talking serious structural issues like a cracked foundation, maybe old faulty electrical wiring that's a fire hazard, plumbing nightmares waiting to happen, a roof that's about to fail.
Stuff that costs thousands or tens of thousands to fix.
Exactly. You might need a $20,000 furnace replacement the first winter, or find out the foundation needs $30,000 in repairs. Saving $500 or $600 on that inspection fee can end up costing you 5 figures just months after moving in.
Yeah.
It's just never worth skipping it. Non-negotiable.
Okay, duly noted. Never skip the inspection.
Yeah.
What's trap number 3?
Trap 3 is the risk of becoming house poor.
Mm-mm.
You win the battle, you get the house, but you lose the financial war.
Meaning you spend way too much of your income just on housing.
Yeah. The general guideline is you shouldn't spend more than about 30% of your net income, your take-home pay, on total housing costs, PITI plus maintenance estimates. When you go significantly over that, you become house poor.
And what's the impact of that?
It's huge. You might have the house, the asset, but you have no financial flexibility. Our sources show nearly a quarter, 23.7% of U.S. homeowners were in this boat in 2023.
Wow, almost 1 in 4.
Yeah. They're sacrificing everything else. They can't save adequately for retirement. They can't build an emergency fund. They might not be able to afford vacations or even hobbies. They own the house, but they have very little liquidity or freedom. The house owns them, in a way.
That's a sobering thought. Okay, one more trap.
A final one that often gets overlooked, maybe because it's less about pure numbers and more about quality of life, but it has financial implications too. Trap 4 is, let's call it, neighborly nightmares.
Bad neighbors or a nightmare HOA?
Exactly. People get so focused on the house itself, the granite countertops, the square footage, they forget to research the context, the immediate neighbors, the street, the rules of the homeowners association, if there is one.
And how does that become a financial trap?
Constant noise, disputes over property lines, maybe unleashed pets causing damage. It can make your home feel like a prison, not a sanctuary. And dealing with a difficult or litigious HOA can cost you time, stress, and actual money in fees or legal costs.
Plus, it could hurt resale value, right? If there's a known issue with neighbors or the HOA.
Absolutely. Word gets around. Serious, ongoing neighbor disputes or major HOA problems can definitely make it harder to sell later, potentially lowering your property value. It's the blind spot regret.
Okay, so we've covered a lot. The tough market, the creative hacks like house hacking and co-buying, the essential strategies like FHA loans and dating the rate. But also these really serious traps. Maintenance costs, skipping inspections, becoming house poor, and even bad neighbors.
It's a complex picture for sure.
But boiling it down for someone listening right now, maybe feeling overwhelmed, what's the takeaway? Homeownership is possible with smart strategies.
Yes, definitely. Things like house hacking, using those low down payment loans, they work. But success really hinges on doing your homework, being realistic, and preparing for the long haul, especially those hidden costs.
And maybe questioning the whole premise.
Well, yeah, I think we really need to challenge that old ingrained dogma that says renting is just throwing money away. That simple phrase pushes so many people into making bad, rushed decisions that end up hurting them financially.
Because the current data tells a different story.
A very different story right now. The numbers are pretty clear. In 49 out of the 50 biggest U.S. metro areas, it is currently cheaper, sometimes significantly cheaper, to rent a typical starter home than it is to buy one.
How much cheaper?
On average, maybe around $1,000 a month cheaper to rent than to own, once you factor in mortgage, taxes, insurance, and estimated maintenance.
$1,000 a month.
Sure.
That's real money.
It's very real money.
So that leads to a really crucial final thought then. If renting saves you, say, that $1,000 a month right now, what should you be doing with it?
That's the critical question. You need to look hard at your personal situation. Does buying make sense for you right now? Or does renting strategically make more sense? If renting saves you $1,000 a month and you actually invest that difference consistently, maybe in index funds, maybe saving for a larger down payment later, you could actually be building wealth and financial security much more effectively over the next few years than if you jump into a 6.5% mortgage and immediately face unexpected repair bills.
So it's about analysis, not just following the dream blindly.
Exactly. Don't buy just because society tells you to. Buy when the numbers make sense for your life and your finances, using a smart strategy. Sometimes strategic renting is the smarter financial move, especially in a market like this.
That's a powerful counterpoint to end on. Use logic, not just emotion or pressure. Okay, we definitely want to hear from all of you listening. What's your experience been? What was your biggest home buying mistake, or what strategy worked best for you?
Yeah. Did you try house hacking? Did unexpected maintenance costs bite you? Or maybe you successfully co-bought with friends.
Share your stories, your wins, your warnings down in the comments below. We really want to build a community around this. And of course, make sure you subscribe so you don't miss our next deep dive into finance, wealth building, and navigating this crazy economy.